Thank you, Marty. Thanks for organizing this great event, and thanks for having us today. My name is Rappaport. I co-chair Gunster's tax practice. I'm here this afternoon with my law partner, David Barnhill, who leads our international tax practice. And our goal here is to give you 15 to 20 scintillating minutes of what's going on with the Biden administration and their tax proposal. So our high-level agenda, and Marty, we will respond to the two items that you discussed as well. But our high-level agenda is for David to discuss the proposals that came out of the Biden administration's infrastructure plan. Those focused more on corporate tax policy. When David's done, I'm going to talk a little bit about the prospect for enhanced enforcement following the IRS commissioner's testimony in front of the Senate Finance Committee last week. And then in the lightning round, David and I will speculate on things you should keep your eye on, and we'll talk, Marty, about the two items that you discussed. So I'll turn it over to David to talk about the infrastructure plan.
Thanks, Adi. Yeah, the infrastructure plan is very interesting. There is, as I think we all know, there have been a lot of proposals that have been floated over the past several months, 9 months even, and the infrastructure program, as Adi said, was more focused on corporate taxpayers. So the big number there is the proposal to increase the tax rate from 21%, where it is currently, up to 28%. And that has some other rippling effects that will go through the tax code that I'll touch on a little bit. It's still lower, of course, than it was before the Tax Cuts and Jobs Act, when it was at 35%, but it does represent a significant increase from 21%. Many of the income and revenue raisers from the infrastructure plan focus on in the international sphere, actually. And part of that, I think, is because it's not, the representation there isn't great. People here, the voters, don't really cry if you tax people who are either shipping jobs offshore or those types of things. So one of the things that the Biden administration has proposed deals with the GILTI tax, which was basically put in as a global minimum tax on earnings of controlled subsidiaries or controlled foreign corporations owned by U.S. investors, and as it is now, the effective minimum rate is about 13%, just a little bit higher, and the proposal for the Biden administration increases that to 21%. Interestingly enough, prior to the Biden administration, the OECD has been working to try to get some kind of a framework in place for a global minimum tax rate. And the Trump administration wanted nothing to do with that. Secretary Yellen has been engaging quite a lot in those discussions. And the current proposal is actually to not impose, it would be voluntary, but to have a 12% global minimum tax that the OECD member countries would go ahead and put on their books. And it would allow the countries to basically top up their own taxes if the controlled subsidiaries in a different foreign country, if that foreign country's tax rate wasn't at that 12%. So they could top up. If it was 8%, they could impose an additional 4% to get up there. Additionally, one thing that I thought was a little bit surprising, there was FDII, which was the foreign derived intangible income, was a regime that was put in place to incentivize companies to keep IP, to keep more production here in the US. It was discounted tax rates for sales of property and goods for use outside the United States, or for provision of services outside the United States. And despite the intentions for that to basically keep and help job creation here in the US, that appears to be on the chopping block as well. Those are kind of the main things. The corporate rate change also impacts the international, because you have subpart F income that I think can be common, and you also have the GILTI, and you can get out of those with a high tax exception. And for the corporate payers, that used to be 18.9%. So if you had an 18.9% effective rate in one of these countries where you've got a business that's operating, then you could generally get out of both of those taxes. However, that increases now to 25.2% with the new tax rate. And also the proposal on the GILTI is where you could aggregate in the past high tax jurisdiction income and low tax jurisdiction income. Now they're going to separate those so that you're really going to be on a country by country basis to minimize. And so really that's going to increase the revenue generated under that GILTI regime. So those are the primary things that we saw. There are some other things coming down the pike that likely you'll see in a little bit the removal of the pref for capital gain, long-term capital gains and qualified dividends. And those will have some interesting repercussions as well, but those are the primary things that were discussed in the infrastructure plan.
Thanks, David. So what I'm going to talk about is the IRS commissioner's comments to the Finance Committee, the Senate Finance Committee last week. And the big headline that came out of that committee meeting is the commissioner of the IRS estimated that the tax gap in this country is $1 trillion a year, which is a remarkable number. So the tax gap refers to the difference between what taxpayers are actually paying in taxes to the US government versus what theoretically they should be paying if they were accurately following the tax law. And so he noted that when you look at what the tax gap was for the years 2011 to 2013, at the time it was 441 million, the estimated amount. So we've gone from 441 million to $1 trillion, which is a remarkable increase. What's causing these gaps, according to the commissioner, are the use of cryptocurrencies, income from illegal activities, foreign source income that David just spoke about, underreporting by pass-through entities, so that would be partnerships, S corporations, funds, etc. The loss of 17,000 enforcement agents and unscrupulous tax practitioners. Hopefully David and I don't fall into that category. For the years 2010 to 2019, the IRS budget was cut by more than 20%. And an interesting note is that there's an estimate that the top 1% of filers account for 28% and as much as 70% of the tax gap. So, when you look at that, what does this mean? It means that the investors, a lot of the people that were at the seminar today, are at the crosshairs for additional enforcement. And it used to be, and David and I were talking about this morning, that a lot of the IRS compliance was focused or targeted on specific things. So, for example, whether it's offshore accounts or whether it was conservation easements, you knew what they were looking at. And if you had not engaged in those activities, you could be reasonably assured that it's not going to be a problem. But now there's a concerted effort to focus on this tax gap. And the reason is because we've had a lot of deficit spending. There's a lot of big progressive agenda items that the Democrats would like to pass, and there needs to be a way to pay for them. And this is a good way to potentially pay for them, is just by enforcing the tax law as written. So one thing that has been suggested by the commissioner, and one thing the Biden administration has proposed, is increasing the IRS funding budget by 1.2 billion, which would allow the IRS to hire an additional 5,000, nearly 5,000 frontline enforcement personnel, and then counterparts in the different divisions of the IRS that deal with enforcement, whether it's appeals or the taxpayer advocate service. And so what I think you're going to start seeing is additional enforcement, additional audits, which means that taxpayers, especially high net worth taxpayers, need to be more mindful about substantiating their tax positions and understanding the positions they're taking. What the commissioner suggested Congress do is strengthen information reporting, particularly relating to cyber currency, so more regulation, and regulating tax return preparers, so there's less shoddy work being done in terms of the compliance of it. With respect to cryptocurrencies, we're already starting to see, for lack of a better term, the trap being set by the IRS relating to compliance. If any of you in the audience have already worked on your 2020 1040, there's a new question that appears directly underneath where you fill in your name and your address. And the question is, at any time during 2020, did you receive, sell, send, exchange, or otherwise acquire any financial interest in any virtual currency? So on its face, the question is asking, did you transact in cryptocurrency? And if you did and you answer no, then you filed a false tax return, which is a problem, obviously. The questions created a lot of confusion. And so, notwithstanding the face of the question, the IRS issued a clarification in early March that purchasing cryptocurrency and doing nothing else does not mean you have to answer yes, although I think that's a bit internally confusing. And so that's something people should take up with their tax advisor. But I think on cryptocurrency, the big thing to consider is that cryptocurrency is not currency like a dollar is currency. Cryptocurrency in the IRS's eyes is property. And when you transact in property, when you exchange your cryptocurrency for an asset, whether you buy a house, a car, or anything else with cryptocurrency stock, you're creating a taxable event. And that's something that's, I think, going to be subject to higher compliance going forward. And so I think taxpayers, the people in this audience, should be mindful of this increased enforcement, additional oversight of cryptocurrencies, and act accordingly. And so as we wrap up, we have a very brief period of time. David, what are you talking to clients about? What are you considering as you look at what tax policy is going to look like in the next 12 months or so?
It's pretty interesting. On the international side where I focus, it's very interesting because all of the changes that are being proposed really call into a question a lot of the structuring that was just done 2 and 3 years ago. And I feel like the ink is just barely dry on so many of the final regulations. So I know that I've got clients that are calling me that are pretty annoyed, frankly, that, everything they've just done may or may not still work and may or may not be the ideal thing. That's certainly an issue. I know for us in Florida, we've got a lot of people coming down. A lot of them are considering coming down because of the limitations on the state and local tax deduction. But going back, Adi, to what you were talking about with the enforcement, that's the Democrats' proposal for paying for the repeal of that limitation is, well, we'll just increase the audits and we'll collect more money to pay for it. And I think the proposals that it would break even in 15 years and then start being a revenue generator after that. So, and that's something, as we've talked about, that is a very, that's on the top of the list for a lot of the Democratic lawmakers because of the jurisdictions that they represent. I definitely see them pushing that through. I could be wrong, but that's something I think that they'll be fighting tooth and nail to get through, and that will, that'll again just trigger audits. There will be more funding to the IRS to make sure that those go through. And as you said, that's going to target a lot of our clients that need to be ready and make sure that all their I's are dotted and T's are crossed. So if the IRS does come knocking, it's a very short affair and not something long, expensive, and drawn out.
And then Marty, I think your question on the state and local tax deduction, kind of piggybacking on David's comment, it's sort of counterintuitive, right? Because now you have people who are trying to figure out a way to raise revenue, advocating for a big tax cut. So, that's the strange game that politics is. So the state and local tax deduction, if it is reinstated, could be a huge tax cut for high net worth people. But it's probably something that needs to happen to keep those people from moving to states like Florida and Texas, et cetera. To quickly comment on your qualified opportunity zone question, I think there's something very perverse that could happen for people who invested in those investments from a tax perspective, because keep in mind, the deal that you made was, it's a two-part deal. One is you get a deferral of your capital gain to the end of 2025. And so that deferral assumed that your tax rate is going to be about the same. So the deferral matters. Well, now there's proposals to increase the capital gain rate for people making over $1 million to 39.6%. I think it's a long shot. I think it's extremely unlikely that happens. But you could see a scenario where someone who invested, assuming they're deferring their 20% tax, is actually getting taxed at a higher rate than they expected. So that's something to keep an eye on. I think overall, I don't see the Biden administration, this is just, crystal ball gazing, like a lot of the other panelists have done, so I'll do the same thing. I think you're going to see more regulation, so it's going to be more targeted, perhaps. I think the goal of the program is sort of has a lot of bipartisan support in terms of getting investment into blighted areas and thinking creatively about how to do that. I think some of what's considered abuse has to do with just maybe more generous definitions of what blighted might mean. So you may see regulations around that. Also, the whole regulatory framework that came out surrounding qualified opportunity zones was very confusing in terms of the testing you need to do to qualify. So, I think there'll be some refinement there, but I don't see it going away.
I just wanted to just get a clarification. I mean, I think Obama was kind of accommodating from a tax point of view, right? I mean, the EB-5 program, we're on Brickell Avenue here, built half of Brickell Avenue, right? So you've got your EB-5 programs, you've got international cash investment in residential homes that happened during Obama's administration as well, where people were coming in from China and Russia and buying up $25, $50 million homes in cash, right? So it's very accommodating in terms of where capital was coming from. And I was just wondering if you guys think there's going to be any kind of a movement in this Biden administration to kind of turn a blind eye to that sort of capital inflow as well. Because obviously, you buy a house that turns into a capital gains for somebody who sold the house, right? So any thoughts?
You want to take a shot, David? I have thoughts, but
yeah, I mean, a couple of things. So one of the things I think is, it partly depends on where the money's coming from. I think that, I lived in Russia, I have a Russian background. And so seeing everything that's going on there with Putin amassing troops, I think it's up to 100,000 troops on the Ukrainian border, with Navalny on a hunger strike in the prison, on charges that most people believe are spurious at best. I think I see the Biden administration taking a much stronger stance against investors that have connections in Russia in certain places in Putin. So maybe there are some limitations there. I think also the new law, as people are investing here, the corporate registration, the beneficial owner registration that's going to be coming into play in the next couple of years. That's going to be interesting. I don't know how much that turns people off from investing here in the United States if all of a sudden they're going to be potentially, their information, their names, identities are now reported to the IRS, and it's potentially the subject of an information exchange with their home country. That may, I don't know that it'll be anything in particular that, would target that type of investment, but I think there may be some of those residuary effects that will maybe limit the investment a little bit more than we've seen in the past.
Yeah, I think it's worth emphasizing, Marty, the corporate transparency movement and the laws that have been passed. I think it's kind of been under the radar to this point, but we're moving towards a world in the United States where, the same way you have a know your customer when you open a bank account, you're going to have to report the beneficial owners of every entity that's formed in this country to either FinCEN or the IRS. And that's really going to change people's view of the United States as a haven for certain types of investments. Because anonymity is something that's, valued. So now a lot of people go to Delaware and they form an LLC in Delaware, and it's very difficult to ascertain who owns that entity. That part of it may not change in terms of the public being able to research that, but the government is going to know who owns each entity, and that could be a game changer. I guess the other 2 points I would make, and there's probably going to be some change in the transfer tax system. So there's been some very aggressive proposals on estate taxation, gift taxation, in terms of the Biden administration proposing that death will be a sale or exchange event. So what they'd like to do is get rid of the step up in basis and have you report your entire gain on all your assets when you die, and have a capital gain event. That would be a huge structural difference from where we are now. And then there was another proposal, for the 99.5% Act, where, the gift tax exemption would move back down to $1 million, and the estate and gift tax exemption would go down to 3.5 million, which is, compared to where we are right now, which is 11 million, is a huge it would be a huge change to the way estate planning works in this country. In fact, more people are going to be talking to tax lawyers rather than fewer to try to deal with that. So a lot of things, to keep an eye on from a tax policy perspective, international tax perspective, and it'll be interesting to see how it shakes out. Probably a lot of.
My only follow-up question, Addie, is with respect to the estate tax. Does anybody look at the impact on family-owned businesses from these estate taxes? Because obviously, there's a lot of family-owned businesses where the overwhelming majority of the estate is tied up in that business. And the greatest example here in Miami was Joe Robbie owned the Dolphins, right? And when he passed away, they had to sell the Dolphins, right?
Yeah, no, I think that's a great point. I think you're articulating sort of the family farms and small businesses are the ones that, are most fragile when it comes to this kind of stuff. So I think that's a great point. And I think, you can plan in certain ways and the tax law gives you some deferral in terms of paying the tax, but it could be devastating, I think. If the pendulum swings this hard in terms of transfer taxes, it could be very difficult for a lot of small businesses.
Yeah, I agree. I think that they would have to provide something, especially if it became a capital gain event, right, at death. I think they would have to include something similar to what they have now for closely held family-owned businesses, where you can defer and pay the estate tax, over 10 to 15 years. You'd have to do something like that, or else death would be just the destruction of a company, or you'd have to sell it to somebody, assuming you can find a buyer.
Right, that doesn't really account for the debt of a company, and you're just going by valuation. It's really a fascinating topic. It's a shame we don't have more time for it, but I think that we've been looking at this for a long time, and we work with a woman who used to run GenSpring in California. She was the head of it, and now she runs something called the Family Owned Business Institute, and Pat Soldano. And one of the things that she'll say, she's been doing polling on this for years, and her polling says there is very little sympathy for super wealthy people who own businesses. So to me, there's a political will, because there's not a bad guy when you increase taxes on people with that kind of wealth, right?
Right, but I think that the emphasis needs to then be made, and hopefully someone can present it to the lawmakers, that it's, if you have to do a fire sale of a company, that may just be the company breaks up, and however many people that company was employing that people actually care about are now out of a job. So
Yep,
you got to kind of balance that, right?
Yep, for sure. Yeah, absolutely. I'm not disagreeing. Well, listen, guys, we have to go and have some drinks. So it's really been fantastic. And I want to again thank Gunster and Milt Vescovacci for supporting us. And we've had some very informative panels, and looking forward to having more in the future. If we're still on, we're going to be in San Francisco May 19th and 20th. Actually, we're going to be in Palo Alto. And we're going to run back a couple of panels on SPACs and some other topics that are in that ballpark. So again, thanks again. And we look forward to having more events with you guys here in Miami. Thanks so much.